Welcome to the Smart Property Investment Show, the podcast by investors for investors.
How you going? Phil Tarrant. I sound like a robot. This is not AI, it's real. Phil Tarrant, Smart Property Investment host. Been doing this for a while. Thanks for tuning in. Everything is different, but everything is the same, is all I'll report on. Property remains property. Still don't know what's going on. Everyone's wondering about interest rates. No one's too sure. What are you going to do? I'm not too sure. That's why my friends at Finni come into the studio, which we used to do this, either Loisance, which I still can't pronounce correctly. We used to do this over the Zoom, but now we're doing it face-to-face because we had so much good feedback when we did our last time we got together. But reluctantly, we brought in a buyer's agent. We probably won't bring him back. That was Paul Glosser from Pure Property Investment. But people liked it, so welcome back to the studio.
It's good to hear.
Yeah. What's going on?
A lot.
Yeah. Good, bad, indifferent?
Yeah, good and bad. We just met actually with a BDM this morning who...
From a bank?
From a bank who bluntly said, rate cut are never going to happen.
Is that what they said?
Yeah.
Like never?
Never.
Big Four bank?
One of the Big Four banks. So
what colour was in the logo? A primary colour?
A primary colour.
A primary colour.
Yeah, so that's interesting to hear that.
So as they're saying, just don't think there's ever going to be a rate cut?
No.
Forever?
No, not forever, but like for a long time.
There's not going to be any this year. There's not going to be any this year.
Yeah.
So you even reckon next year. Yeah. But this is the point, and I've been making it.
Do not budget on the fact that you think there's going to be a rate cut.
First point. Yeah. But second point, and probably more importantly, and I think I was moaning about this last time we got together, even if the Reserve Bank of Australia cuts the official cash rate, the likelihood of banks passing that on without any pain is probably going to be very, very low.
Correct.
So, just because when the RBA goes, good luck, good news, everyone, we're taking 25 basis points off the official cash rate, the banks are going to be very, very slow, if at all, to pass on that to the consumer. So you got to get rid of the refinance. That's the point we made last time.
Yes, and that's why I think this podcast is going to be very good for a lot of people, is how to get prepared for that time.
Now, I am wearing a jacket inside, and the reason why is because I just quickly whipped down a ramen noodle and spilt most of it on my top. So if you're wondering why I'm wearing I think they call it a gilet or something. I don't know. Is that a phrase? Gilet. Is this a gilet? The gilet. Which what they reckon is like a tech bro thing to wear these days, or a finance bro thing anyway. I'm not a finance bro, but I do like talking about mortgages. That's why I'm wearing a jacket inside. But so when we got together last time, we sort of spoke about this, saying property is a game of finance. Let's summarise. Property is a game of finance. Your ability to access finance is critical to grow a portfolio. Your ability to cover the debt connected with finance is actually critical to your ability to hold a portfolio. So finance is everything, right? I don't know any property investor who wants to have a mortgage, right? Most people, if they could have property without mortgages, they'd be really, really happy. It means death pledge, right, in French? Yes, there's a death pledge. Mortgage, death pledge.
Until you're dead. Yeah.
Yes. And you see what it means until you're dead?
Yeah, until you're dead, all the mortgage is dead. Yeah. That you've paid it in full.
Yeah, okay. Yeah. So the two sorts of death, right?
Yeah.
You're dead or the mortgage is dead.
Whichever comes first.
Whichever comes first. So I don't know anyone that wants to have a mortgage. We need to have mortgages as property investors. And I don't know anyone with a mortgage that wants to pay over the maximum interest rate that they have to pay. I don't know anyone who's going, 6.5%? Nah, make it 6.7, make it 6.9, doesn't matter, happy days, right? So everyone wants the cheapest rate possible, and the strategy is that you don't want a mortgage, right? That's the name of the game. But your ability to access debt means it's going to enhance your ability to secure property, and your financial capability is going to mean, and how you invest means how you're going to be able to hold property. So we're at an environment right now when we're getting a report here, firsthand, ground truth, if you want to call it that, that this lender, BDM, reckons there's not going to be any reductions to mortgages for a long time. So there will be a point in time when rates are going to come down. So in the interim, you've got to work out how you can get cheaper rates while you wait for that to happen. That's one strategy, and we should be talking about that today. And or when interest rates start falling, how do you make sure you're ready to refinance if you can't get your bank to pass on those savings? So that gives us a basis for shaping this chat.
Yeah, correct. That's exactly it.
Yeah.
Either to negotiate with your bank or make sure you're ready to move
Yeah.
if needed.
Why did the lender come and see you guys? Is that so you recommend more of their products, or like what's how? Tell us about the inside world of mortgage brokers.
Yeah, so we would meet 1 or 2 every week. So I don't know, CBS, St. George, whoever would just come and meet us and talk about their product and what they make, how they're trying to make it easier for us and what's changed, what policy, I guess how they're trying to get more business in.
Okay.
So
they're salesmen.
They're salesmen.
Or salespeople. Yeah.
Salespeople, yeah.
And do you sit there and roll your eyes and go, oh, I don't want to see this person? Or are you actually genuinely interested to hear what they're doing?
It depends who.
Okay. At least you're honest. Yeah.
Yes, obviously there are banks that are doing a lot more for brokers and trying to actually help people getting better deals in a way that's easier. And there are lenders that just, that this is our products and that's it.
So they come in and they go, hey, we've got a really good interest-only product for investors who are buying it at 70% LVR. It's on special right now. You can get it for 6-something%. That's what they do. That's good intel for you guys. Then you go, oh, okay, that's cool.
So we get, I don't know, probably 40 emails a week on updates and things that happen. So to be honest, we don't have time to read all of them and to remember all of them. So I guess it's a way for them also to be the last person
Top of mind.
that had an influence in.
Yeah, okay.
Yeah.
All right. So how long do you sit with one of these lender BDMs when they come in?
An hour.
Really? Do you like give them a coffee, or do they bring cakes and stuff in with them?
They should.
Yeah, they don't.
Not all of them.
Pastries, no, but some do.
We get coffee often, but
yeah. So they come in. Do they know who you are, or they just got like a book of people they got to go to, and they go, "Oh, hi." Do you know who they are?
Yeah, I think Finni writes enough volume for us to be quite valuable to them.
Oh, so you're special.
We're very special, but there are lenders we don't use very much, and they actually don't bother coming. They would just send us an email or a phone call.
So it actually matters, like the lender
Yeah,
relationship.
it does.
You just don't, because everyone goes, oh, we've got the best software to work out who the best your lender is or the best product for your needs. So these BDMs come in and actually give you info of what's going on. So you hear about stuff potentially before other people.
Yeah, so I guess it's a way for us to really make sure we are on top of what's going on and make sure we put the client in the best products that's out there. And I think also for the client, when their situation is a bit on the edge of working or not working, if I call, I don't know, Bank A and I sent 20 million worth of business to them last year, they're more likely to give me a bit of a favor there than if I go to Bank C where I only sent 2 applications.
So does it help you as mortgage brokers, and maybe this is too much for inside secrets, and you can tell me, no, I'm not going to answer that question, but the better your relationship with lenders and lenders that like you and your team and the Finni business, the likelihood of getting sharper pricing with them because of that relationship, is there something in it?
No, not pricing. I wouldn't say pricing. It's more when there is a bit of a grey area of policy or something that just need a bit of a push for the assessor to approve it.
So you get a little bit more leverage.
Yeah.
Yeah. And that's okay.
Yeah,
right? That's if you're not using a mortgage broker, you're probably not getting that capability.
And what we can do a lot is escalating file if it's urgent.
Yeah. So you get stuff happening faster because
definitely.
Because you're a bigger company, you write. There's a bit of
And
a term,
that's
but you
nature
write
of
good
human
business.
relationship, right?
Yeah.
You've got good relation, people are going to help you more than if you just call somebody out of the blue. Who are you again? And
Yeah, so relationship matters. Okay, so therefore you give them the time of day. A lot of lender BDMs listen to this podcast, by the way.
yeah,
They probably
I love
hate
them
me,
all.
but-
Please come and see me.
Yeah.
Yeah.
If you don't, go and reach out to the Finni. Well, just go to your website. I'm sure they can find you pretty easy. But you must be on all the aggregated information and all that sort of stuff anyway. That's interesting to know. But no interest rates for a while. So you got 2 choices. You refinance today. So, sorry, you got 2 choices, 3 choices mainly. Call up your lender and go, I want to get my mortgage repriced. I think I'm out of the market. What are you going to do for me? And there's 2 things that are going to happen there. They're going to go, yes, Mr. Tarrant, we can shave X number of basis points off your mortgage. And they go, no, it's not moving. And then you got to suck it up, right? Your option there is to sit there and keep paying the mortgage that you're paying for at the interest rate you're paying for, or you can refinance at that point in time. You can threaten that to the lender, and sometimes that
it
works.
became a lot harder. Like a few years ago, I remember even for myself, I called my bank and they sort of beg you to stay and give you a cashback just to stay when it used to be just for refinancing. That doesn't.
Well, they just give you cash back just for loyalty,
$4,000 not to remove.
but not change the interest rate.
They did also change the interest rate.
So they change the interest rate and give you $4,000.
Do not move.
Okay, that's not happening anymore.
It's not happening anymore.
No, okay, because they're just going, well, good luck, because everyone's rates are the
And it's now
same.
more and more common that banks say, sorry, can't do anything.
Yeah, okay. So they just go, nah, too bad.
Too bad, that's right. And I think they know that it's hard for people to refinance. They sort of don't have the capacity. Or people are still on fixed term, or they have a year or two worth of interest only remaining on their term, where if they refinance, they're going to lose that.
Yeah, okay.
So
Yeah.
they have the power.
So the balance of power at the moment sits with the lender.
Yes.
So they if you're way out of market, they might reprice it to keep you, or they're just going to go, nah, too bad. Just that's the way it is. And so you have a choice then. You either sit there and go, okay, suck it up, and I'll wait around until interest rates come down and hope that they may pass them on, or you can now proactively refinance to get a better rate, better product for your needs today, thinking and considering that interest rates might not go down, but you might be able to save some money. How many people are doing that right now?
We actually have a lot of refinance.
Just state refinance stuff. Yeah.
Yep.
And they're refinancing for the purpose of
Interest
better
rate.
products and rates, or to release equity?
There's a few things. So people are coming out of fixed term. We had the 1.99% CBA for 4 years. That was amazing. People are, that's the end of it now.
Good old days.
Or people finishing up their 5 years interest only. So that's a great time to look at, okay, is my bank offering the best here? Moving, and we've got a lot of people as well that are self-employed and maybe had to go with second or third tier lender because they didn't have tax return ready or whatever. And that's a really good time as well to upgrade and maybe go to a full doc product where you can get competitive rates.
There's lots of moving parts, isn't there? So many different reasons why you need to speak to your mortgage broker. Yeah. So of those people who are coming off fixed rates, they must be nearly towards the end of it. There's no... from 1.9 to 6 point, that's a big shock, right? For those people, for those people who come off while rates were going up, at least they come off and then they rode the wave and become normalised. But if you're coming off 1.5 to 6.5, are you seeing a lot of that?
Yeah. Yep. And the issue we have with that is often the bank or their broker priced that fixed term for 4 years, and when that's finished, they end up with the standard variable rate with no discount.
Yeah.
So suddenly it's not 1.9 to 6.2, it's 1.9 to 8.5 because there's no discount
That
applied.
happened to me on one thing, yeah.
Yes, so, and then if they don't do anything, that can take, time to fix.
How many people don't know that they're on, I'd like to think most property investors know, but maybe owner-occupiers who, they come off an interest only or a fixed and go on a variable with no discount, who are paying way over and they don't even know. Do you see a lot of it?
Not a lot, but that happens. Does happen. Or often it happens when people are part variable, part fixed, and they assume when the part fixed goes to variable, it will be exactly the same as that variable loan they have, but that has been priced. The fixed hasn't been priced for variable. So.
Yeah.
Yeah.
And normally
and the bank won't call you to say, hey, do you want me to give you a discount?
No, they don't. And we spoke about this last time, right? You got to and this is not beating up the banks. The banks are in the business of making money, but they're not going to go out of their way to pass on savings to you. You're going to have to. It's going to have to be led by the borrower rather than the lender, unless they're absolutely forced to by government or they put some new regulation in, but banks aren't going to be quick to pay. So essentially, either way, either it's today, tomorrow, or the next day, you got to be ready to refinance. Welcome back, Phil Tarrant, chatting with Eva from Finni Mortgages, finni.com.au. CM mortgage broker market share is the biggest it's ever been, ever. It's like 74% of all loans now.
Are we going to talk about all those articles? And
No. I think it's, I think it's been done. I think they had a crack. It was about two months ago about banks. Banks sort of at war with brokers, one bank in particular at war with brokers. I think we're beyond it. If 74% of Australians want to use a mortgage broker, doesn't matter what anyone says. But some lenders make it harder to work with mortgage brokers, but luckily, if you've got a good broker, they'll be able to find alternatives. how much differentiation is there really in products? Here's a key question, right? Is one lender got such a good product that I have to use that? Or there's always something which is similar or nearly exactly the same somewhere else?
There's not many options out there.
Completely unique.
I would just put a warning there where people use online only lenders or products. Often it's very restrictive.
Yeah.
You can't get equity out, or one of the big banks launched a product recently. Once you're in, you cannot reprice ever.
Is that in the policies?
Yes.
Buying it on, so getting it online.
Yes. So you got your loan, you got your rate. That's it. Yeah.
So this is an important point, Eva, and buyer beware. One of many things that a mortgage broker does is that they'll actually understand and interpret the policy for you and make sure it's right for you. And people go, oh yeah, my mortgage broker, I use them to get a home loan because they get me a better rate. Like, for most investors I know, the rate's important, but it's not the most important thing, right?
Yeah, and I guess they're not targeting investors. They're
not
targeting mum and dads that have had properties for 20 years and have a small loan and they're not doing anything with it.
Yeah, so they just really, that's good business for them. It's and call it dumb money if you want, right?
Yeah, that's exactly,
it's a bit, sounds a bit horrible, but it's like they would, banks, they would rather lend money to, they're going to say completely the opposite because they've got rules and they're governing it. They would rather more naive borrowers than sophisticated borrowers, because a naive borrower go, oh, well, really, I can get a rate at 6.5%. That's 0.2%, whatever, cheaper than what I'm paying right now. But in the fine print, it says you're never going to be able to reprice that. It's always going to be the same forever. That's crazy. But that's the business they're in.
You're telling me.
But you can actually refinance it. No one's got a product that says you can never refinance.
Oh, no, of course you can refinance. It's just you're never going to be able to get a better pricing than
the one you got right now.
Or if you want to actually get cash out for whatever, your holidays.
Well, it might not have an offset or a redraw facility.
No, definitely not.
So they get a really nice rate, but they can't.
It's not even really
the rate's
nice.
not good. So who would choose this then?
Someone that's really rate driven and not doing anything else with their money really than paying their home loan.
Yeah. Look,
so it's probably not the audience we have here.
No, I don't think so. But yeah, but there's people out there making these decisions. But anyway, so let's just assume you're going to have to refinance at a point in time, because your banks might not pass on any interest rate savings, or there might be a better product out there for you. So, how do you go about doing it? I've asked you to write me some notes here, and we'll do an article on this at smartpropertyinvestment.com. It's pretty good. You said here, check your capacity to remortgage your own debts and your overall servicing capacity. What do you mean by that?
Yeah, so it's not because 2 or 3 years ago you could get a loan for $800,000 that you actually could get that loan again. And it's actually very likely that you can't service for that debt if nothing else changed. So if that's the case, you're in mortgage prison.
Yeah.
You can't move. So I think it's quite important to check now, and if you actually can't get that same home loan, to find ways to get to the level that you need to be able to move if need be.
Okay, so again, this is the potentially balance of power sitting with the banks in that. If they sit there and just go, good luck trying to move your mortgage, right?
Yeah,
because you just won't get the serviceability somewhere else.
Yeah, and just to share a bit of insight there, it's not an exact science, but roughly you can borrow 6 times your income.
Okay.
For an owner-occupied property. And I'm not talking if you have kids and credit cards and car loan, but let's say someone that earns $100,000 can borrow $600,000.
So that's not your take home. That's $100,000 at top.
Average.
Really...
What we can do, obviously, if you've got a credit card, that's a bit less. If you've got 3 kids, that's a bit less.
And that would be if you're investing in your personal name.
That's if you buy your home.
Yeah.
Your home to live in. Obviously, if you're an investor, you also get rent.
Yeah.
So that's
all income. And if you're in trust, it's all changed again.
But I find people are always shocked to think, oh, is that it? That's what I can get.
6 times your salary.
Yeah. It's probably more 5 these days.
Really?
Yeah.
5 times. And this is the issue, right? Like, the average salary, I think, is like 95 grand in Australia. Is that right?
Yeah, it doesn't buy you a house in Sydney.
Doesn't buy. Well, I've got to call that out, though, because you can actually still buy property in Sydney for $600,000.
Yeah, you can.
You can?
You can. It's true.
You can buy property all over Australia still for that much money.
True.
Yeah. Might not be on the water in Sydney. Yeah, you might not be a stone's throw from the CBD. You might be 70 kilometres away from.
Yeah, don't call that Sydney anymore.
Well, Camden, Penrith.
Yeah.
Or if you want to move closer in, it might be a one-bedroom apartment. You buy a one-bedroom apartment within proximity to the Sydney CBD.
Well, it's just hard when you've got a family, 3 kids. That's
and
not
that's the
gonna
issue,
work.
right?
That's not going to work.
That's where it gets problematic, right? So elsewhere. But, this idea that it's impossible to afford property in Sydney if you earn the median salary.
No, it is hard if you want to live in the property. If you want to invest, that's a completely different story.
proposition.
And that's definitely the way people should go now, I think, is reinvesting.
Yeah. Yeah, which works well. So another point here, check your current lender's offering and compare with the market average for the same product. So is this really giving yourself evidence to call up a bank and say, oh, no, I can get this rate somewhere else?
Yes, and that's the issue I've got with a lot of clients. They will call me and say, hey, you got me 6.2, but I can see 5.95 online. Yes, you can, but it's no offset. You don't have anyone to call. You can't actually do any... You don't have any transaction account linked to that account. You have to compare apples with apple. And if that's what you want, then yes, I can get you that. But often it's not.
What you want.
It's not what people want.
And that's the role of the broker to really
Yeah.
pull back those layers and work out really what someone wants.
Yeah.
So you can't get a really, really cheap rate with heaps of features. If you want heaps, and people talk about features. The features are redraw and offset facility, right?
Yeah, redraw offset,
Yeah.
the ability to split the loan, the ability to have a credit card maybe free with that. There's a lot of things linked to a little bit more pricing sometimes.
So this about getting your own sort of situational awareness. You need to know whether or not the product that you have, it might be a good product. You might be on the best product. I reckon I'm probably on the best products I could possibly be at right now.
Yeah, I think so. I feel like sometimes people miss the opportunity to get repriced because they call the bank and they're quoting rubbish. And it's like saying, oh, I want this Ferrari for the price of... It's like, dude, that doesn't...
Not the way it works.
They just... Yeah, that's not... so I think they need to prepare and make sure when they call their bank to say, look, I've seen this and that's actually exactly the same you're offering and there's 0.5%. Yeah.
What I find, if you've got a larger portfolio, and this has worked well for me, where I've caught up a lender and have gone, I have exactly the same product with all exactly the same features for a very, very similar house in the next suburb, in the same structure, and they're 50 basis points cheaper than you are. They've told me they'll give me that on this property straight off the bat, no issues, because they've just done a whole bunch of refinancing with me. I'd like to keep the loan with you. What can you do? Often they'll just go, yes, sure, no, done, right? But it's evidence-based, and I can actually say, I have the sophistication to say, this is a direct comparison. It's very similar loan for a very similar property in the same structure. Everything is the same. The only difference is the interest rate, and they will match it straight away because they've just done all my refinancing. Yep. You'll find how quickly they'll
that's
shift to
it.
give that.
You just need to have, I guess, a reasonable explanation to ask for that cheaper rate.
Yeah, and then when like you can do that yourself, and mortgage brokers can do that for you. Good mortgage brokers will do that for you. But when the bank comes back and says, nah, go for it. They're smart banks. They'll go, yeah, I don't reckon he can't be bothered, he's not ready to do it because he probably hasn't got his finance done. It's a bit of a game. And enjoy the game,
it's a game,
all right, that's a good point. So a point here you said about LVR and valuation. So again, this is these are variables, right?
That can be a bit tricky. So, obviously the property market is in general doing well, but sometimes isn't, or sometimes the property price haven't moved as much as you wanted to, or maybe has gone down for the property you've purchased. So if you're still on over 80%, even if you refinance to a cheaper rate, the fact you're going to have to pay LMI again might not be worth doing. And that's important to get into checking the value of the property with a broker because we can check with different lenders. So it might not work with Bank A, but Bank C actually got you a really good valuation. It's now under 80%, so we can refinance. So don't stop at one.
So is that okay for if someone comes to you and and they want to refinance, you get them a valuation, and the valuation doesn't stack up. You can go to another bank and get another valuation, and another bank and get another valuation.
Yeah,
when do you stop doing it? When you go, look, don't worry about it.
No, look, we see a rough estimate before we go for it. And if we can see the range actually could be, I don't know, if it's between 4 and 500 and we need 490 to make it work.
Yeah.
The first bank came up at 470. We can see that maybe the next bank, will go for it. So we try. And then, after 3, if it's not working, it's not
It's not working.
No.
But is that a lot of work for you and your team to do that, or is just that's what you do?
That's what we do.
Yeah. And do you find certain banks do valuations differently? Like, is there certain banks that
know.
always give higher valuations?
Yeah, we know.
That's the secret, right? You're not going to tell me. If I ask you,
no, I'm not going to tell you. But we know, depending the location, which bank is going to be more favorable.
So it actually matters.
Yeah, definitely matters.
So who the valuer is in a particular location for a particular bank will change the valuation of it.
Yeah.
And this is an important point. So just because the bank valuation comes up higher doesn't necessarily mean that
it's the actual
that's the value of the property, right?
Correct.
So you may be taking on more debt than is proportionate to the actual real value of the property should you have to sell it. Or if it's overvalued at the point of refinancing, you might not get the growth that you expect from that property when you refinance again, because a lot of it's factored into the first round of valuation you did.
Yeah, those valuation are just,
It gets tricky, eh?
Gets tricky.
Yeah. God.
But the value really, to me, it doesn't actually matter. The real value of a property is whatever someone's actually going to pay for
it
next time.
And depending on the cycle, sometimes bank valuations are way under what they are.
Yep.
And sometimes they can be way over. Like I've got bank valuations sometimes going, and don't be greedy just because they value it up. Don't think you should take all of it. Maybe you want to do that. It's something you probably got to talk to with your property strategist. But all right. So LVR and valuation is important if you're looking to risk. So these are all the info you need to know before you can be effective. Yeah. Okay. You speak about rental increases. Is this to make sure you're getting the maximum? Yeah.
So if you find yourself a bit short to be able to service for your debt, if you happen to have investment property. And I know, if you're a tenant, you're not going to like this, but you can review the rent every 6 to 12 months and bump it up, I don't know, $30, $50 per week on all your properties if you got a few that sometimes can be just what you need to make it work.
So that'll increase your serviceability to support refinancing. Yeah, okay.
That's one thing to review that often people don't think about enough.
Yeah. And anyway, you should be, I would say, maximising the rents on all your properties as a property investor. Now, there's always a social discussion around this, and a lot of Australians are struggling, and cost of living, and I acknowledge all that stuff. But you need to, as a property investor, have comfort. And my position is always people should be paying what market rent is. I don't expect for people to pay over market rent, but I expect tenants to pay market rent. But you also have your obligations as a landlord as well, right, to ensure that the property should be getting market rent. And maybe it's your market rent and someone else's view of it are two very different things. You might go, well, every other property's $400 a week. Why am I only getting $380? Well, it's because you don't have an air conditioner. There's no fans in the room. It's old. Needs this, that, and the other. So again, it's very variable. But in terms of rental increases, again, it's the game in that there's a lot of new rules, even in Queensland, that just changed around rents can only go up once a year. In Queensland now, it's not on the tenant, it's on the actual property, which is another complicated. You and your team across all this stuff?
Yeah. Look, I guess we check with our clients, when is the last time you had a rate increase? Is it up to market speed? And just to remind them that might be something, to look into.
Yeah.
Yeah.
Yeah. And if you're self-managed, you got to work it out yourself. But if you use a property manager, they should be able to tell you what market is. That's what they do. Don't always get it right. And I find this is maybe a bit topical that sometimes you've got to push your property manager to get your rents to market rent, because I do it all the time, and they go, well, yeah, but they can only afford $50 a week increase, and you'll go, well, yeah, but the market of this area is this, and therefore it's an 80% increase. Well, they can't afford it. Okay, well.
Yeah, I think the thing to consider here is if you change tenants and you lose 2-3 weeks worth of tenancy, is it worth that extra $20?
This is the point.
This
is the point. You got to make these calls and these decisions around it. And so it happens at every negotiation happening everywhere, whether it's with the lender or with the tenant or the property manager. You don't normally negotiate with your mortgage broker, do you? They work for you.
We work for you, Phil.
Yeah. Do you?
Yes.
Yeah.
I think in the negotiation is more in terms of explanation of why things work or things don't work. Yeah.
Do most people get it? Like, or are you sort of always explaining ideas and themes?
No, we do explain, and I guess especially for purchases, it gets stressful for people. So we cop a lot of.
Yeah, you probably cop it, right? I know brokers like.
Yeah, we cop a bit of. I guess people just need to vent and let the stress out, which we understand, but sometimes it's a bit like.
My hot tip would be nice to your mortgage broker. You get a lot more from your mortgage broker when you're nice to them. You don't want to be that person when their phone starts ringing, they look at the number and they go, I don't want to.
If we know your number, just when you're calling us, it's not a good
sign. You don't know my phone number, do you? Yeah.
I saved it. He's like,
God, don't answer.
Don't answer.
Oh God! But all this stuff matters. And if you're looking to refinance, right? Yeah, if you're a good client for a mortgage broker, they should be on the front foot going, hey, look, your rate's too high. I've spoken. Do you know what I like when they go, I've already spoken to the bank and they're going to take 20 basis points off your mortgage. You just go, that's cool. Yeah, good job, By the way, so what we're talking about here is getting ready to refinance, being set to refinance. And that might be for now because you're not happy with the rate or the product you have, and or it's about preparing for a downwards interest rate cycle if you're not satisfied with rates being passed on. And or you're looking to grow your portfolio and you're looking to extract equity to capitalise on the market right now. So there's a whole bunch of reasons why at any point in time you should be ready to refinance or finance. And the best investors I know have always got a pre-approval sitting there waiting in the wings, right? So that's pretty cool. But there's some other points here that are a little bit more tactical to increase your ability to maximise the refinancing potential or be a better client. We'll get through that. Welcome back. Getting ready to refinance is what we're talking about with Eva Loisance from Finni Mortgages, finni.com.au. Now, Eva, you said in these notes here, and thanks for the notes, they're really cool. PAYG pay rise, study for a better pay industry, get a better role, second job. Ideal is 12 months minimum with some exception. Right.
You just went all out there.
Yeah. So this is saying if you're going to refinance, be the best client you can be.
So if you are an employee, I guess, and have another pay rise for a while, with inflation, you're just going backwards, right? So I'm not saying everyone deserves a pay rise, but I think it's worth asking if it's on the table. Sometimes $5,000 to $10,000 can make the difference in someone's serviceability. We've had clients, I guess, that also were forced to upgrade their skills. And they did it not just because they think, okay, I can be better in my job, it's just because they wanted to get the investment property.
So people have actually done that?
Yeah.
So what do? They go
I think it's amazing. Or someone completely changing industry because they loved what they're doing. It's just that some industries just don't pay too well, right?
How many people actually change their industries or their jobs for the purpose of being able to access more money?
Look, it's not many, but we probably had like 5 or 6 that I can recall very well because it's life changing, really. Yeah.
What's the most significant change in someone's career you've seen in order to be able to borrow more money?
So I've had a youngish girl, she's 25, working in childcare.
Yeah.
So
they don't get paid very well.
They don't get paid very well, and she went into software sales, tripled her income.
Tripled her income.
Tripled her income.
Was she a good salesperson?
Yeah.
Yeah.
Yeah. She's got a lot of empathy. She worked with kids. She's very patient. The worst will
sound like they make really good mortgage brokers.
Yeah.
Just saying. You probably triple your income being a mortgage broker than childcare if you're good at it.
Probably, but yeah. So that was significant because she what's the chance of a huge increase like that in the previous job?
Possible.
None.
Probably her manager with 20 years experience probably not earning that money.
No.
No, personally, I think childcare workers should get paid a lot more money than they do. So should nurses and AMBOs and cops and all that sort of stuff. They get paid enough. Teachers, particularly, compared to what they can get elsewhere. We're lucky to hold on to them in these very important roles. But you say here that not all income is worth the same. Isn't a dollar?
Nope.
So hang on a sec. But basic economics is $1 is $1.
Yeah.
But according to a lender,
It's not.
it's not.
It's not.
Please explain.
So if you earn a base income and then on top commission, bonus, travel allowance, a car allowance, all these sort of things aren't worth $1. They are worth 0.8% on average.
Okay.
So it's better to ask for a pay rise of your base than actually getting more bonus or
commission.
in terms of lending anyway.
So if someone said, hey, I can give you, I'll use really simple numbers because I'm a pretty simple guy. I'll give you $20,000 more on your base salary, or I'm going to keep your base salary the same and give you the opportunity to earn $40,000 in commission for the purpose of borrowing.
Yeah, then in this case, commission would be worth more at 80%.
Yeah.
Yeah.
So you've got to just do that math, right?
Yes, you need to.
So if it's 10 grand different, you probably just go.
The issue is commission. We need to see at least 6 months worth of your commission to see you actually good at your job and you would get the commission. If you get an increase in your base from day one, we can
instant.
use it. Yeah. Same thing if you get a second job, the banks will want to see that you are able to keep 2 jobs.
Yeah. So it's just not like a flash in the pants.
Yeah, it takes time.
And how long do you need to be, if you change jobs, roughly how long do you need to be in that new job before you can go for financing?
Yeah, so that's a question I get asked a lot. If you stay in the same industry, you just got a better job, better pay, that's fine. We can use it right away.
Okay.
Yeah, because banks like, you've had, history, you're good at it, that's fine. If you go from being a childcare person to software sales, they will want to see, that you've passed probation and you can actually do the job.
Okay.
So some lenders will take 6 months, but
again, they'll be different. There's different policy. The answer is why you need a mortgage.
The ideally would be a year. So that's why it's good to prepare in advance.
Yeah, that's why you should be getting ready now. That's the reason why we're talking about it. And if you go from full-time employment to self-employment, how you need a couple of years of financials?
That's a really hard one. So the banks if you want to refinance for better rates, you want to be like the prime client, right? So we can do low docs and all these things, but prime client will need 2 years worth of ABN.
Yeah.
So that's 2 years from today, and have 2 years worth of tax.
2 financial years?
No.
2 years of operating.
And 2 tax return.
Full financials or
you don't need full financial. As long as it's services, it's okay, but you need 2.
Okay. So you need to actually be doing it for 2 years.
Because most business would fail during that time. Yeah.
And you need to show profit in those financials.
Yeah.
Is that a good idea?
Would be a good idea.
Yeah.
Pay your tax and
And it's an important point also. So if you have a running balance on the ATO, if you go for a finance application, you're self-employed and your tax payments aren't up to date, and or you're in some sort of payment arrangement, they won't give you funds.
No.
It's very hard.
Correct.
Yeah. So you've got to make everything needs to be up to date, and you need to be fully compliant. If you're self-employed, and this is why a lot of people struggle as self-employed lenders, because for whatever reason they might be a bit sloppy with it all, or they might not keep their taxes up to date for whatever reason.
Yeah, and they want to delay things. So now, as of today, we need 2023 tax return done, right?
Yeah.
So, and people sometimes drag it for a bit longer than
that. So how often, say, when did lenders start needing 2023 tax returns?
Some April, some in May.
Okay, so you had up until January, February, maybe March to still have your 2022 financials. So if you have a good financial, so let's talk about this practically for a moment. If you've had a really, really good FY24, as in where we've got 2 weeks left of that, if you had a really good FY24 and a less than good FY23, you'd be wanting to get your tax return done as quickly as possible.
Correct.
Because it's going to put you in a better lending position. However, if you had a really, really good 2023 and a reasonable FY 2022 and your FY 24 is not so good for whatever reason,
you do it now then.
you're best off kicking the can down the road and not doing your tax.
Yeah, and lodge your application
And
before
lodge
it's
application
due.
before it's due, which would be May of next year.
May next year.
Next year.
Yep.
So essentially after the end of the financial year, you've got 10, 11 months before lenders are going to start wanting to see what the performance was from the year beforehand.
Correct.
Yeah, this is really tactical stuff. And
But if you
a
think
good broker and or your accountant should be working through this.
It's quite generous if you think about it, because we are 2 years after the tax return were done almost.
Yeah.
So now they're lending money based on what your business was doing 2 years ago.
Yeah. It's good.
So
And if you're self-employed, and we're talking about this now, this is the sort of point you said, self-employed, get your tax returns done. You're going to have to pay tax. I'm sorry for those people who are self-employed. If you want to borrow money, you're going to have to show profit, at least, and you need to show your ability to manufacture income. Now, if you're self-employed and you're a sole trader, it's going to be a different application than if you are in a partnership or if you're a PTY-TD. You got to show how you're paying yourself out of that PTY-TD, and be able to prove the continuity of your ability to pay yourself out of that PTY-TD. It's a big thing for a lender, right? Yeah. And you got to pay tax. If you're not, if you're losing money, they're going to go.
Well, we go with what's on the paper. It might be very different in reality, but if your papers are showing a loss, well, technically you can't afford a loan.
How many people say to you, yeah, but even, that's just for tax. I'm really making all this money.
Well, yeah.
Does it happen a lot?
Yeah.
Yeah.
It's like, what do you want me to send me a picture of the cash on the, it's like, how am I going to prove that
And did people go, but I'm actually making lots of money. I just, this is the way I
it's my
structured things."
accountant. I don't know what it's done.
Yeah.
Yeah.
How do people blame their accountant?
Yeah, hips.
Yeah, this is why you need a really good accountant if you're a property investor, someone who actually understands, because most accountants will be sitting there going, I can add the greatest value to my client by them within the rules available to them is to minimise the amount of tax. Like that's the game, right? And if if that's how you brief your accountant and that's your expectation what your accountant to pay for, or within the rules, I may add, it's important, and the tax office are getting very good at catching people that don't follow the rules, but there is certain accountants know the rules better than other accountants, and certain accountants are very good at applying the rules. And again, it's an application of those rules. If your brief to your accountant is tax minimisation, that's okay, and they'll do that, and they should do it inside the rules. But if your brief to your accountant is, I want to borrow money, well, they might treat certain things a different way. They might be capitalising expenses rather than putting them at P&L and all this sort of stuff, right? And it actually can change your ability to borrow money, particularly if you're refinancing. I'm not giving any financial advice there. I'm just giving a view of if you want to refinance or if you want to borrow money and or refinance where you are right now, your financial position and the message you send your lender of the health and the integrity of your finances will absolutely determine whether or not you can refinance. Yeah. Lenders like lots of profit. They like to know that because they're giving you money. They just want their money back.
It's just enough to service your loan. That there's enough to repay. Yeah.
And is self-employed income treated differently to, say, if you're PAYG, like commissions or bonuses and stuff, or it's all $1 is $1?
$1 is $1.
Okay,
Yeah.
that's good to know. Unsecured debt. So if you're getting ready to refinance, so I imagine you're going to tell me don't have it or make sure it's no balance on it or rip up the credit card.
I think people think, the car loan or credit cards or the easy pay, afterpay, whatever, small debts, that's how they see it. It doesn't affect much of capacity. But really that can be a killer. And especially a car loan or novated car lease. They
don't like that stuff.
That's just really bad.
Yeah.
Yeah.
Most people have a fancy car these days, though.
Of course.
Do most people have car, like when they come across there? Most people got car.
Well, look, actually, people that have understood the game don't have car loan or good cars.
Okay.
Yeah, but you'll have the first-time investor often. Yeah, they'll have a car loan with repayment of $900 a month.
And they work out that's just bad.
That just kills capacity. Yeah.
And stuff like I can think of one. I saw it getting marketed the other day. It was an Amex card with no limit.
No limit. Yeah.
It's like so, but from what I understand from people with these cards is that there sort of is a limit, but it's no limit. The limit is what they feel should be the limit at any point in time based on your trading history with them. So, like, you can't get a card and then go, hey, unlimited, I can buy a house, a couple $100,000 with it. Like, it's probably not going to work, but it's unlimited. So how do banks treat that debt?
Yeah, that can be a bit tricky. Often they base it off the base income of the client.
Okay.
So they apply a percentage of what is reasonable for them to spend.
And this is this HEM stuff, isn't it? Does that still exist? The household, is that still a thing?
Yeah.
HEM?
It's still a big
What's it
thing.
stand for?
Household expenditure measure.
So they would say a typical family in Australia might make, I'll use easy numbers, whether this is correct, $200,000. So they would say they would expect these are the expenses for that standard typical family, and they benchmark you against it.
Yep.
Yeah, okay.
Yep.
It's always, I often
But
think about
some will adjust it also based on where you live. If you live in Sydney, you're probably going to spend more than if you live in, I don't know, Wagga Wagga.
Yeah.
It's more than just the income. It's a location of
it all. I've often thought about this, and I'd like to know the answer. If they assume, like, you know, depending on what you earn might dictate the size of your house or the car you drive or whatever, but on most of the stuff that people pay for, it probably can't change that much. Like if you earn $1 million a year versus $200,000 a year your family, you're probably going to eat the same amount of food, right? Like, does that, like, how do they change it, like, in a HEM thing?
Because you know, your family that's struggling to eat, they will eat the 2 minutes noodle 50 cents. But if you're earning a lot more, you will have takeaway and spend $100 a night.
Yeah, okay. So it is actually relative.
Yeah.
The more money you earn, the more you spend on food.
You'll eat much better food.
Yeah, God. Okay.
You'll have a better car, or you'd put, premium fuel or instead of E10 in your car and all these things.
Okay.
Yeah.
So does it matter what fuel put in the car? E10, you seem to know. It's do they really measure everything? Do lenders really measure this much stuff? Like how?
Well, no, we have to declare the average that someone spends a month. Obviously, they're not going to be able to check every detail, but based on your income, technically, I guess with social pressure as well, you want to spend towards whatever you earn.
Yeah.
That's the nature of as human, I guess.
Yeah. Okay. I'm still eating like I ate when I was a kid.
Yeah.
Well, it's a university student.
Yeah, but you might be spending money on other things that are important to you, and food might not be.
Food might not be one of them.
Maybe wine or cheese.
Maybe. Maybe. I still buy my champagne from Aldi.
Yeah.
There you go.
Yeah, but champagne, see?
It's good.
Not the VB and.
No. It's real champagne. Have you had the champagne from Aldi?
No.
It's very good. It's only $30 a bottle.
Okay.
Only $30 a bottle. Good luck trying to get champagne. That's not Aldi for that, but anyway, I highly recommend it if you want to keep an eye towards household expenditure. But little things like that matter, right?
They
like,
do.
you know,
They do.
budgeting and.
So the way we do it is we look at 3 months worth of your statements. There's a computer, not me, but the computer does it and will tell me they spend that much on food, that much on clothes, that much on.
So on that basis, then, if you're going to go and refinance, you might want to tighten your belt for 3 months.
Yeah.
It matters.
Correct.
So don't buy fancy champagne, buy Aldi champagne. Don't shop it here. So every little bit will matter.
Yep.
Yeah. So put off things, maybe, you know. Is that manipulating the system? Is that like, you know, and this comes to the point. You can do that tactically to try and present yourself as a better borrower to the bank, and therefore they might lend you more money as a result of it. You need to be responsible for the money that you borrow. So if you change your spending habits for 3 months in order to maximise your lending, you may be taking on debt that you can't afford. So if you do that, you're going to have to pay, right?
Yeah, that's true. But remember that the bank, the way they check affordability, there's so much buffer built into it.
Okay.
That, you know, if they say you can afford, I don't know, 100K, it's probably because in real money you can afford 200.
So this is a buffer, this 3% buffer.
There's 3% buffer. There's buffer on everything. You know, they only take 80% of your commission, but you actually get the 100%, or 80% of your rental property, but you still get 100%.
Okay, so there's structural buffers,
Yeah.
and
They
there's
know
buffers.
people.
They know people always undercook it, do they?
That's right.
Yeah. Have you been have you seen mortgage applications and have gone, this is what we spend? You go, nah,
Yeah.
no way.
Yeah.
You know, but you're only lying to yourself. And the point being is that if you take on the debt, you got to pay it. And this is the responsibility point. You see it happens all the time. People go, I can't afford my mortgage. Well, you took it on. You know, you've got to be responsible. And like, again, property investors. And some people just don't know what they're doing. But, you know,
Yeah.
if you try and shape your mortgage application so you can borrow more money, and it sounds like that's sort of part of the game, you're still responsible for paying the debt. So be
Correct.
careful what you do.
Yeah, and look, in there's a lot of discretionary expenses as well. You know, like you can always cut on things for most people, especially when you start investing. But it's look, it's a game. But at the end of the day, you're the one making repayment, and that's the game that's dangerous with trust lending these days, where people keep buying through trust. But at the end of the day,
Still got to pay for
it's
it.
them behind the trust for all their trust, and they have to make the repayments on.
So structurally, it might help with your serviceability,
Yeah.
but at the end of the day, you got to find the money somewhere.
Yeah, and I've got clients where they have like 5, 6 trusts. It would be nowhere in the world in the personal name they would have got that. But technically they are behind the trust. There's no difference.
So they're like super redlining, are they?
But not technically in terms of servicing,
the
because
lender.
the way it works with trust is you're not taking it into account.
Are they charging a premium on trust loans now? It's probably a result of that, isn't it? Is it try and put some risk in there?
Yeah, there's a bit of premium.
A lot?
Some,
A bit?
No, not a lot, but
Yeah.
not cheap.
No, this way you got broken. And last point here, Eva, you said non-comparable living expenses is the thing.
Yeah, so going back to HEMS, household expenditure measurement, is they will take whatever you technically can't avoid to spend, so your fuel, your food, bills and all that. But whatever is extra, if you have private school fees, or you go and have a massage every week, or if you do things that people don't technically have to do to live on, that goes on top.
Okay.
So if you, I don't know, at the end of the month, technically have 500 surplus and you spend it, for your kids' private school fees, well, you're in the red.
Yeah, I was chatting with someone yesterday, and who was I chatting to? Let me think. It was a really good conversation. An accountant, and they said from them doing a whole bunch of tax returns, you would be surprised how many families are insolvent, and that's what you're talking about there. It's like they're spending more than they're making. You know, now a measure of solvency is whether or not you can pay for your debts when they fall due. Is the traditional measure of solvency. So you might be spending more than you're making, therefore you're using reserves of some sort.
So those credit cards and afterpay.
Which can potentially exacerbate you, become insolvent and your stuff. That's when you go. And so this accountant told me, I know this accountant well, he's seen, it doesn't get reported and you don't really see it, but there are so many people, property investors as well, selling properties at the moment to remain solvent. And I was like, really? Like the numbers I'm getting from like the Commonwealth Bank, for example, post-budget, was there's still more money. There's more money in the system in offsets and residuals than ever before. And he goes, yes, that's correct, but it's a tale of two cities, right? Like you've got one end of the spectrum where they're still reasonably resilient and they still have money in the system, and even if the cost of living pressures are come up, they've still got plenty of capacity to service their financial commitments. But he says there's a whole bunch of other people, and he's seen, and this person does a fair bit of investing business, where he's seen people selling properties all over the place because they are insolvent.
I haven't seen that yet.
You haven't seen it?
No,
Yeah.
no.
And he would know. Like, I'd like to think he would know. And if he's tuning into this, he's going to remember the conversation I had with him. And I was like, really? Like, but everyone's got all this money in savings and offset. And he goes, yeah, some people do. Not all people.
Not the one selling, obviously.
Yeah, so there's a lot of people who are really,
That's actually a common thing for investors, especially when they start to underestimate the cost of holding a property throughout the year before the tax return comes. And I think it's probably a bit of a panic thing.
Yeah.
More than the experience investor that would just wait and hold tight until the storm passes.
Until the storm passes.
Yeah.
So, and you're absolutely right. It's a moment in time, and it might be until the storm passes. That's when the storm becomes too intense that you got to change direction and get out of it.
It sounds a bit of a panic thing.
Yeah.
To me.
But what we're talking about here is refinancing, right? So there's some ways you can move through the storm, and refinancing might be a way in which you can get back to a level of solvency, right? If you can shave hundreds, if not thousands of dollars, if so for every $1 million of debt you have, what's 1 basis points in repayment of that every single year, every single month?
Be 800.
Yeah.
Yeah.
Matters.
Yeah.
Certainly matters.
It would make a difference between a property that you have to chip in or not.
Yeah, and that's the big deal. So it's all about holding it. This is the point.
Yeah.
Smart property investment. That was good, Eva. Thanks for the chat. Thanks for the detail.
That's cool.
It's long, 55 minutes talking about mortgages. Who would have thought?
Yeah.
Do you hate talking about mortgages, which isn't directly correlated with you writing loans?
Oh yeah, I hate it.
Yeah.
No.
That's cool. How's your new broker going, Robert?
Yeah, good.
Yeah, I haven't met him yet.
Haven't you?
No.
Well, let's go down.
Yeah. Is he cool?
Yeah.
He's doing well.
He's an accountant.
I know, this is crazy. Do accountants make good brokers?
Not all of them.
Okay.
They have to be the social type.
Yeah, true. Might be good with numbers, but you got to be able to talk to people.
Yeah.
Yeah, okay.
Yeah.
I'll have to go and meet him. But well, thanks for coming in.
Thank you.
Finni.com.au, Finni.
Yes.
All right, go and check it out. You guys too busy enough?
No,
Happy to help
we
more?
just got someone new there ready to go. So
Yeah, you fill up his calendar pretty quickly.
Yes.
Doing loans. Is the average loan size increasing just in general with mortgages? Is it, most property investors probably all invest around the same amount, right?
Yeah, most investors we see are looking probably it's 550
Yeah.
purchase price. Yeah.
What I would say for all brokers out there, and even for Finni, but this mainly directed at our listeners, investors, you're talking about refinancing your investment properties, but probably the biggest single individual piece of debt you have is probably your principal place of residence. So you can do all this stuff on your investment side, but if you're overpaying on your principal place of residence, you're an idiot. So speak to Finni about that. Make sure, it all starts really for many people with their principal place of residence. That's what gets them in the property and maybe be an enabler for extracting equity moving forward. So your principal place of residence is where you should be ensuring absolutely that you got the right loan at the right price for it. But while you're at it, maybe have a think about, how you can maximize any equity that you have in that for developing a property portfolio further. That's not advice. I'm just saying that that's where it starts and finishes. So you guys, maybe it's a misnomer. You guys, I know you're property investment mortgage specialists, but you're also specialists that own occupier stuff, right?
Well, that's the easy part. We do our eyes closed. Yeah.
Yeah.
I'd love to get more of those.
More own occupier stuff, right?
Yeah.
You heard it. And if someone just calls you up, hey, I've got this is a debt on my own occupier. What do you reckon? You go, yeah, we could probably do something with that. Yeah. Okay.
Yeah, that's very easy to check. If that's all people have at this stage, that's an easy one.
All right, good. Okay, give Finni a call. They'll help you out. Thanks for tuning in. smartpropertyinvestment.com.au is where you find all this sort of info. Smart Property HQ, social media, or on the Instagram, Smart Property Investment, which people seem to like. Thanks for tuning in. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.